Time for our home economics series. Today we are focusing on how to finance a property. The Bank of Canada, as we know, has revised its key interest rate to 4.5%. Yes, that is the highest since 2007. So how do the soaring interest rates affect your purchasing power? We're going to find out from mortgage broker Mary Cialtzis. Nice to see you again, Mary.
Good morning. Nice to be back.
Okay, so we had the rate announcement yesterday. So what will the latest interest rate hike by the Bank of Canada do to mortgage rates and when?
So it will only impact variable rate mortgages and lines of credit. So fewer and fewer borrowers are taking variable rate mortgages at this point because of the instability. So it's going to affect them more than anybody. The rate yesterday, the increase, is actually going to cause about $246 more per month for every 100,000 somebody's borrowed. So that's for variable rate borrowers. Now, if you're a buyer and you're looking to buy, to figure out how much you qualify for, what I call mortgage math is that you can borrow up to about 4 times your before tax income. So if combined family income is $125,000 a year, you can borrow up to $500,000. And then anything you have for a down payment is over and above that to get you to your purchase price.
Okay, that's a simple way of looking at it to give you sort of an idea of what you can afford, right, Mary?
Exactly. It's not 100% accurate, but it's a very, very good point to start with.
So you were saying that this latest rate hike by the Bank of Canada, it's only going to, at this point, affect people who've got these lines of credit or variable interest rates. But are we not going to see the fixed rate rates go up?
No, it's actually driven by the U.S. bond market and the Canadian bond market. So they're actually they responded differently to the situation. So the variable rates are driven by the Bank of Canada. Fixed rates are driven by the bond markets.
Let's talk about mortgage terms. At this point, if you are looking to lock in a mortgage, would you suggest you lock in at a 5-year term, or knowing that potentially we could see those rates go down in a couple of years, would you benefit from locking in something, maybe a 2 or a 3-year?
That's the thing. It's very tricky. 2 and 3-year rates are not that aggressive. Most of the time you get the best, lowest rate with a 5-year fixed. Most, but not all the time. But it really depends on a person's individual situation. The challenge is that if you lock in for a 5-year fixed and in a year or two, things start to stabilize and rates start to come down, you're going to have a bit of rate envy and you're going to be jealous. And so to get out of your existing fixed rate, you're going to have to pay a big penalty. So this is where really you have to sit and speak to your professional, a mortgage professional, about your situation and what your longer term plan is. Because if you sign up for a 5-year fixed rate, but you know that your 1-bedroom condo is not going to be enough for you, your partner, and your future children, don't do it, because you're going to end up paying a huge penalty. So speak to a professional and sort out your situation. I
want to ask you about the stress tests. Do you think the rules will relax because rates are so high, or we just par for the course right now?
Honestly, I don't know. I understood the reasoning for it at the time that they did it because the rates were very, very low. And so we're now at that stage where a lot of those people that were first in on those stress tests are now coming up to maturity, and they're going to be thankful that they were stress tested because rates are so much higher. So do I see any future changes? I don't know.
Yeah, big question mark
I wish?
on that one. Yeah, I know, exactly. Okay,
yes.
Mary, I got to ask you about down payments. What's the minimum down payment lenders are looking for these days?
So it's a little bit of a more complicated calculation. So the minimum down payment required in Canada is 5% of the first $500,000. Anything over and above the $500,000 is at 10%. So it's convoluted. So here's the quick math. It's $25,000 minimum for $500,000. If you're looking at a $750,000 house, the difference between the $500,000 and the $750,000 is $250,000. 10% of that is $25,000. So you would need a minimum of $50,000 to buy a $750,000 house.
Mary, there's so many more questions. I'm sure we'll get to it with our next chat. Thank you so much, though. Appreciate it.
No problem. Have a good day.
Hey, thanks for watching. If you liked this, be sure to subscribe here, or you can check out more Your Morning videos right here.